Welcome back to the IB Investor channel. In this video, we'll take a peek into the most recent earnings report of Axfood, the Swedish grocery retailer. We'll cover the share price development, the sales and profitability, cash flows, debt situation, and the dividend yield. Now for this company, I figured since it was less than 2% of the total float being shorted, I think we'll just skip it for this video. Now for the share price development, and this company do have a different picture, I would say, compared to many other companies that I recently covered. So the share price development has been more smooth, so to speak, more of a compounder characteristic, which means that it's been almost in a straight line here, compounding, not linear per se, but at least going up in a more steady pace and not so volatile going up and down like this. However, as of late, the stock has been trading down from its top levels here, roughly 25%. The stock has traded down, so a little bit of a back to normal situation. We'll cover some of the metrics later on in this video to see what the metrics were during this period, but it's lower at least. And if we check here for the total, or not total, but the max return here for this period, since the 90s here, you can see the stock has returned 1100% roughly, and this is not including dividends, so with dividends it would have been much more. Here we can see the 5-year period, so it's still in the greens, or in this case in the blues, which is good, and also for the 3-year period it's in the positive. But if you own the stock in a shorter period than that, you're probably in the reds here, as we can see. However, for the most recent week at least, it's been trading up 4%. So much less volatile stock is my assessment here. We can also see that it's one of the more commonly owned stocks here on my broker, with 86,000 owners here at Avanza, so certainly one of the more popular stocks. Now for the financials of this company and for the income statement, we can see here that the blue one here is the sales, the net sales, and we can see that the net sales are going up slowly but steadily, which is good. This is what investors like to see, slow and steady, and no hiccups where it's going down, but rather upwards slowly, which is good. We can also see the EPS here for one, since it's actually positive for this period. I managed to include it here without it looking messy. So we can see here how the EPS growth has been pretty nice up until the most recent quarter here for the rolling 12 months here, where we can see that it's actually down from the period here of 2022, which probably then explains why the stock or share price has traded down 25%, even though the EPS is down less than 10% here, as we can see. We can also see that this company has very thin gross margins here at 13.7%. So, it's just going to mean that, as we can see here, the profit margin are going to be low as a consequence. So when you have low gross margins over across the whole period here, as you can see, there's no way that the profit margin is going to be much better, but rather it's going to be super slim as well. And we can see here, sitting at 2.7%, it's barely making any profits. But that's not to say that it's a bad company. But looking back, we've seen here during this period here in 2021 that the profit margin here were at 3.7%, so certainly a little bit higher, 1 percentage point higher than the current one. And we can also see here during this period in 2020, they had high gross margins here at 15.9%. And high gross margin, it's only in reference to its own margins. Having a 15.9 margin for this period is, comparing it to an industry company that normally sits at like 35-40%, so it is quite low. And luxury companies obviously are sitting at like 60% plus as reference. Now this paints a very nice picture. So we have the free cash flow margin here, and this is one of the few companies here in a long while where I've recorded where we can see that we have positive free cash flow margins across the board, although it was close here in 2021, but still it's very nice. And comparing it to some peers here, we have Europris, which sits at 10.6%, and the Finnish Kesko here that sits at 3.7% in the most recent quarter. Just comparing it apples to apples, it's just this KPI. It doesn't say anything about the other metrics, but at least just to give us a reference here. And now for the free cash flow per share, we can see here that it currently sits at 13.3 kroners here, and it has been positive as we saw in the previous picture here with the margin. So it follows suit here where we can see that it has been positive also in kroners, which makes sense. We can also see that the company currently trades at a 5.4% free cash flow yield at this current in the most recent quarter here. Now for the cash flow overview, and we can see that this paints a very nice picture here where we can see the blue one here, the cash from operations going up nicely in a good trend. We can see that the capex here has been, it seems, a little bit more heavier here at the end, but they have acquired Bergendahls, some of the business from Bergendahl, a competitor, and then also investing in new stores and also some new logistics center. I think it was in Bålsta or Borås or something like this. So a brand new logistic facility here. So yeah, but as I can see here, just as a quick assessment, it just looks very good. This is what investors like to see, that over time the cash flows are growing and the investing side of the business is under control, I would say, especially here. We'll see it on the next slide, but it's not too bad. And this company is posting free cash flows as well in the green here, which we like to see, of course, as investors. Peeking into the debt situation, so we have the net debt here in the blue line or blue bars, and then we have the cash from operations here on the orange again. So my assessment here is that this company has recently here made a lot of debt or acquired some debt here, which in my opinion, of course, isn't good. But I mean, this company probably has to grow somehow, so they probably took out some debt here to probably build new stores or acquire some companies, as I mentioned, Bergendahl, and we can see it here in the figure that the net debt has been increasing from a situation here where they didn't have any net debt, they have more cash here on hand. So yeah, I mean, the assessment here is basically that it is a little bit worrisome that the net debt is increasing at this fast pace. At the same time here, as we can see that the cash from operations has been declining and not following suit here with the net debt. So this is something investors have to follow here and monitor closely in the coming quarters, because if the gap here continues to grow, then you should be, it is kind of alarming in that case then. But right now it's still under control. I think when I calculated this real quick, they have roughly 1.9 years to pay off the total debt right now, the current debt level. So it's not too bad. But as an investor, I don't own this stock right now, but as an investor, speculator from the sideline, what you would like to see is that the net debt at least comes down and that the cash flows from operations at least are stable or going up, so that the gap is declining. Now for the net debt to EBITDA, I mean, this pretty much paints the same picture as we saw previously, where the debt was going up from a situation where they were debt-free. But still 1.7 times, it's not too bad, I would say, right now. So it's not alarming in that sense. But obviously, if they can come down to this situation, it's obviously better, financially speaking. But yeah, 1.7, it's not too bad. Looking at Europris, some peers here, 2.1x net debt to EBITDA multiple, and then Kesko, the Finnish company here, 2 times net debt to EBITDA. So the peers are actually trading at higher levels here compared to Axfood. So Axfood wins this match, at least in this metric. Now for the enterprise value to EBIT, this company actually trades at quite high levels here, 20.4. We have to bear in mind that this is not a tech company. I mean, it doesn't have explosive growth, nor does it have explosive margins, margins up at 80-90% levels, but rather we saw the gross margins at like lower teens. So this company actually trades at a fairly high price, I would say, all things considered. And looking back here at the EV to EBIT multiple here, we can see that in the past it has actually traded at a much lower point. And we can also remember, as you saw on the previous pictures here, the net debt were much lower here during this period. So investors are actually paying a premium, I would say, considering now that we have a higher debt situation for this company compared to the earlier years here. So, it's just something to bear in mind that this company looks a little bit overvalued still, as it looks right now. It has come down from the top levels here at 2021, but a 20 times multiple here, I think that's rich. I think that the company could certainly trade down to 15 times or something like this. Obviously, the peers are trading at much lower valuations here. So Europris at 10.7x and then Kesko at 12.2 times. So yeah, I mean, the EBIT to EBIT multiple, it is a high level here, I would say. So investors just, be careful. Now for the dividend yield of this company, we can see here that it currently trades in the most recent quarter here at 3.3%, which is actually quite a bit lower comparing it to the history here of this company. So, we had in 2015, you could buy this company at a 5.7% dividend yield, which is obviously much higher comparing it to today's most recent quarter here at 3.3%. And, it has been around that level, I would say, for the past few years at least. Obviously, in 2020, there were probably some worry in the market where the yield went up a little bit. But, looking back here, the yield has been much higher in the past. And comparing it down to Europris, which has 6%, which is very high, and then Kesko at 6.9%. So the peers, I haven't checked their stock prices. Maybe it's the case that maybe as of late that their stock prices have gone down a lot, which explains the higher yield or something like this. But comparing it just apples to apples, you're paying up for the premium here for Axfood, where you only get a 3.3% dividend yield as of right now. Now for the CEO remarks for this company, and strong quarter, I do agree. Stable profitabilities. I mean, the margins were a little bit decompressed here in the trailing 12 months figures, but nothing special. I mean, sales were up at least, so the net sales I think were up 8.7% or something like this year over year. So they are selling more, but I'm not sure what the mix between volume and prices are. I don't know this, but the sales are up by 8.7%, and I would assume that there has been some price increases, but this could also be the case that maybe they want to take some market share here because they're not the biggest player. The biggest player in Sweden, as far as somewhere, is ICA. So, reducing the prices a little bit here could give them a market share opportunity here to grab some more market share. And I think that's perhaps what he's trying to do, but he's probably not just laying it out there for us to read it plainly, because that could seem pretty obvious then for ICA as well to pick it up, but that's just what I'm assuming. He also mentions here this new logistics center in Bålsta, which is expected then to improve efficiency and sustainability in the future. And this is what many big companies are doing right now. They're working much more with automation, which is certainly happening here at Bålsta, where they have automated a lot of the processes here compared to the other logistics center that they had in, I think it was Jordbro or something like this, another part of outer part of Stockholm. But I'm not sure, with any machine and automation, I mean, if it stops working, then it stops working completely. You get nothing out of it. And if you have a forklift that breaks down, I mean, at least maybe you have 100 other forklifts, so it won't affect your efficiency so much. But yeah, we'll see. They probably have a good plan here. He also talks about some, sustainability food here going forwards, and I've seen some examples where they mixed real meat with some vegetables, to make some sort of mix, making maybe the change a little bit easier for some people. But I don't know if people are going to buy into that. But yeah, I think at least here there are no big challenges, and especially since sales were up, I think it looks like it's a pretty good quarter. It's going to be interesting to see how they end the final quarter, of course, for this year, but nothing really that sticks out that we haven't mentioned already. Alright, thank you very much for watching this video concerning Axfood. If you have any suggestions on new videos going forwards, if you maybe have some specific companies you would like me to make videos about, comment below or post on Twitter or tag me on Twitter and make your proposal there, or perhaps even comment on some of the subjects that I ask concerning which companies I should make videos about in the future. Anyways, if you liked the video, please hit the like button below and subscribe for more content going forwards. Thank you very much for watching. Have a nice evening.